The twin fears over the future of the Eurozone and the danger of the United States dropping over the fiscal cliff continue to put pressure on global growth. Confidence is further hit by a loss of momentum in key emerging and developing economies. The setbacks to the recovery have led the International Monetary Fund to mark down its outlook for the global economy to 3.3% growth in 2012, nudging up to average 3.6% next year.
I think there are three factors holding global economic growth. So the first one is fiscal consolidation in advanced countries. Now, as we know, it's needed, but it's slowing growth. The second is uncertainty about what policymakers are going to do, political uncertainty, if you want, both in Europe, and mainly in Europe at this point, but also in the US, in Japan. And then the third is a slowdown in emerging markets, in the main ones, China, India, Brazil. Now, because the world now is so interconnected, what happens in one part of the world has an effect on the rest of the world, and so all these things are combining to slow down growth.
Worse yet, the IMF says there is now a 1 in 6 chance of global growth dropping below 2%. That would mean recession in advanced economies and subpar growth in emerging markets countries. To avoid a sharper downturn, the IMF says two things are critical.
To avoid a sharp downturn, it's very clear what's needed is that policymakers take the right decisions. So if you look at Europe, the Eurozone now has put in place, in principle, an architecture which is very coherent. The problem is implementation, and they really have to implement it. That's the key. In the US, we're getting closer to this thing called the fiscal cliff, which is a potential increase in many taxes, which would be a catastrophe if it happened that quickly. So here it's clear that there has to be put in place a fiscal plan, not only for this year, but for the coming years, which is credible.
If these policies are put in place, growth in advanced economies will limp on with an average growth of 0.75% during the second half of 2012, improving slightly in the first half of next year. The weaker demand from advanced economies and financial market uncertainty are putting pressure on growth in emerging and developing economies. This is compounding the challenges they face at home, such as slowing domestic demand following previous interest rate hikes and budget cuts.
It's clear that emerging economies are affected by what's happening in advanced economies for two channels, the usual ones. The first one is trade, so lower exports. The other is financial. They basically face capital flows, inflows, outflows. That complicates their life a lot. In some cases, you have more than that. You actually have a weakness of domestic demand, which may be due to policy, fiscal or monetary, and that is adding to the slowdown. So in general, indeed, for the main ones, China, India, Brazil, we've revised our forecast down quite a bit.
The IMF says that the upside from the slowdown in global trade is a marked improvement in global imbalances. These imbalances occur when importing countries like the US run a large trade deficit in relation to exporting countries running a large trade surplus, such as China. Because such imbalances must be financed by often volatile capital flows, the IMF tracks them as a vulnerability for the global economy. A vulnerability that appears to be decreasing but still remains high. Blanchard says there's a key to reinvigorating growth and reducing these vulnerabilities.
Policy action. It's clear that not only it would reduce downside risks, but it might actually create upside risks if it's done right, both again in the Eurozone and in the US. It could be that uncertainty, which is very much there and leading consumers and firms not to spend, could actually decrease, and we could be surprised on the upside. It would be very nice.